investing styles has pros and cons that are better suited for different people. For example, you wouldn't recommend a 20-year-old put half their money in bonds and half their money in dividend stocks. Now, although those are very safe investments, it doesn't take into account the level of risk that that 20-year-old is able to take on and the time horizon they have to withstand that risk. Instead, you'd want to suggest something that has the potential to generate higher returns due to that time horizon. Alternatively, you wouldn't want to suggest to your grandmother that she invest her life savings into a potentially high growth startup that's yet to actually turn a profit. Although it might be a great investment, that's far too much risk for someone at that stage in their life who will need that money soon. However, if you were to reverse those situations or those recommendations, it might be perfectly reasonable. The point here is there's no one-size-fits-all approach. Your strategy depends on your goals and your life circumstances. And there may not be one single methodology that works best. You can create a blend of strategies. But the most important part is once you get a plan together, is to stick to that plan. Now, doing so can sometimes be easier said than done. As we've discussed, the stock market is volatile, and downturns are inevitable. This can cause fear and panic and lead even experienced investors to make mistakes. One of the most common and costly is panic selling, or selling your investments due to short-term fluctuations in market prices instead of sticking to your long-term strategy based on the fundamentals. And this panic selling can be quite costly. It has two primary impacts that are basically opposite sides of the same coin. First, it causes you to lock in your losses at that low point. And second, it prevents you from partaking in the recovery after the crash. Whether we look at the 2008 financial crisis or the 2020 pandemic, or other crises even earlier, the stock market has always recovered from and then surpassed its previous highs following major market crashes. But in order to participate in that recovery, you have to maintain your ownership of your stocks throughout that period. Research suggests that these market crashes are actually some of the best times to buy stocks. For example, Guru Focus research indicates that some of the highest periods of insider buying activity were during some of the biggest financial crises in recent history. That's likely because as many of these stock prices plummeted, the insiders with intimate knowledge of their company's fundamentals were able to see that those stocks were dramatically underpriced, and instead of selling, bought more shares as the market was crashing. That's largely why Warren Buffett is famously quoted saying, "Be fearful when others are greedy, and greedy when others are fearful." If you can resist the urge to sell good companies, even when the stock market as a whole is volatile, you can potentially ride out this volatility and even capitalize on those mispricings. Now, there are several strategies you can implement to stay disciplined during these periods of volatility. One of the most important is keeping a long-term mindset. Focus on the fundamental value of the companies you own as opposed to the short-term market price fluctuations. Having this long-term mindset is essential for riding out these periods of volatility. And in order to focus on those fundamentals, you want to have a data-driven approach, as opposed to focusing on headlines. And additionally, as often as you can, you want to build in a nice margin of safety in the stocks you decide to purchase. Margin of safety describes the difference between what you believe is the intrinsic value of the stock and the actual market price. Having a large margin of safety allows you to build in room for error. Another important thing for long-term investors to keep in mind is that timing the market is far less important than what you actually invest in. A study by Charles Schwab, linked in the article accompanying this video, found that even investors who invested their money at the worst possible times throughout the year outperformed those who didn't invest their money at all over the long run. One of the most effective strategies in the study was something called dollar cost averaging, which is where you simply make investments during recurring intervals throughout the year, regardless of what the market is doing. This strategy performed excellently over the long term.